How do you identify a property boom? How do you know when to buy into a market? There's a thing called timing the market and time in the market, and it's impossible to time the market. Now, I agree. I reckon 20, 30 years ago, even 10 years ago, the data that we had back in the day was pretty much days on market, vacancy rates, and that was it. And you'd open the magazines and it would be a month, 2 months, 3 months old, and you'd scroll through and you're like, oh my gosh, this is the place to buy in. That's not the case anymore. You can actually really start to identify where are the markets that are moving, where are the markets that have had exponential capital growth. And actually, is capital growth the only driver? If a property market's grown 50% in the last 3 years, does that not mean, well, what about that market that grew 100% in 3 years? So we needed to figure this stuff out. We needed to get down to the nitty gritty of it. We got on Matija from HTag, which is a data platform, and he talks all about the anatomy of a property boom, to kind of dive in deeper about how it actually works, how it's gone from a historic perspective and what's happened in the past, and how we can kind of start to see the signs of how we can identify it in the future, because we can't buy the past anymore. So where are the deals at? Hey everyone, my name's Joe Tucker, and together with Jeff Miles, we created Oz Property Investors. It's Australia's largest property investment community. We got over, 84,000 property investors. Each week we interview experts because we want to know, where are the hot spots? Where are the not spots? Where are the areas we should be buying? How should we be thinking about this stuff? And you got to be a fly on the wall to these conversations. This week is unreal. Whole heap of information, whole heap of data. Matija goes off like a frog in a sock. And you kind of like, you'll get it. You'll get what I mean when we have this conversation, because he just shares a whole heap of stuff. So this is one of these ones where you're going to have to rewind, watch. Anyway, let's jump into the session. You're going to get a lot of value out of this, how a property boom works and how can we take advantage of it. Let's jump in.
Now, there's usually this narrative that states that if something has grown in the past, it will not grow in the future. Now, the assumption that's being made there is that future growth is determined from past growth. Okay, so if something has grown 50% in the last 5 years, that means it will not grow into the future. Now, that's completely incorrect, because growth happens from supply and demand. What might happen is that you might have an area, and one of these areas has been voted for in the group to be discussed. You can have an area that has grown 50% in 5 years and yet still has a reducing supply and an increasing demand, which means that it will continue to grow. Now, the question is for how long and how much? Of course, that needs to be determined. But just because Perth has grown X amount, it doesn't mean it will not grow into the future, especially if it has a reducing supply and an increasing demand. The question is, okay, how much growth does it have left? Townsville, for example, has generated 100% growth in 7 years, okay? Which means that just a year ago or 2 years ago, I wouldn't have invested in Townsville if I used that same thesis, i.e. 50% growth in 5 years. So
you would have missed out on 50% of capital growth.
Correct.
However, it is an indicator where it's like, well, how far can it go? And then that's when it comes into the bigger question of, well, what's driving that fundamental growth? What infrastructure is set up? What is actually changing the supply and demand dynamics? And is that still going? Is it still happening? And other people that are moving to that area wealthy? It's kind of like if all of Sydney just decided to move to Brisbane, all of Melbourne, right? All of Melbourne decided to move to Brisbane. Would Brisbane be more expensive than Melbourne? Well, it actually is right now. You can't buy within 30 minutes of Brisbane for $600,000.
With capital growth and owner-occupiers versus investors, is it like, given that 70% of owner-occupiers are in that market, can you then sort of say that it's largely still booms are driven by owner-occupiers first, or is it the investors? Like, who kind of, have you got information on that? Or is that
yeah, absolutely. Now, two times larger lending cohort is the owner-occupier cohort in compared to investors. Okay,
yep.
So that means that sorry?
How much money does that mean? How many loans are getting?
Yeah, so essentially 2/3 of purchasing happen by owner-occupiers.
Yep.
Massive. And also they're the ones making
no.
emotional.
And I'm talking about across Australia. Yeah. Now it might vary on the basis of a particular region. What I'm trying to say is that, it is mostly the owner occupiers who obtain loans and actually purchase property. Which is why you only have X amount of, how many? 2 million investors in Australia. Not everyone is. So bottom line is what I'm trying to say is that, this comes back to the affordability question. Okay, so when you speak about affordability, you speak about affordability within that particular suburb or that particular region, which is going to ignite the demand or the purchasing patterns. Okay, and it is mainly every time you see an area that has turned into a hotspot, it usually starts with owner-occupiers trying to purchase property, and they're driving that initial wave of demand. Okay, you usually see that now, especially because investors are relegated to different price points. Now, most of the times, and Joe can confirm this, I mean, in the last 100 briefs that I've received, I would say over 95, let's say between 95 to 97 for a price point that's below 600K. Okay, so investor participation is very rare in price points that are above 600 or 650K. Okay, you have here and there essentially, those investors participating in market, but it is rare. Bottom line is, even in markets that are below 600K, it is mainly the owner occupiers who are beginning the purchasing, which is essentially moving the area of the needle from 0% growth in a year to, let's say, 5, 7, 10. When you're hitting the 5 or 7% mark to the 7 or 10, you already have competition between owner occupiers and investors. Now, the beautiful thing or the interesting thing about it is when an area reaches a bubble territory, what you usually do see at the back end is that mainly the investors are purchasing. Owner-occupier demand has dropped off, and you see the investor saturation there, which is manifest as very high vacancy rates and both increasing short-term and long-term trends. So to answer your question in a roundabout way, it is anyway the owner-occupiers that are buying most of the homes. Okay, so that's a given, which is why the affordability and the affluence of that specific suburb is one of the primary factors which drives not only the initial birth of price growth, but prolonged price growth as well. So yes, the area is primarily affordable for the owner occupiers first to see that trickling in of initial demand into the suburb.
I see a lot more sophisticated investors, smarter investors that have access to, like your platform, for instance, incredible platform, access to supply, demand, vacancy rates, understanding of the macroeconomics and the microeconomics of a region. And then what that does is you spend an hour on there, you're like, cool, I've got some good understanding about this. But then, how does that interact with the market as itself?
So that's actually a very interesting question. Now, there is a notion that's called in equities and crypto called exit liquidity. Okay. Now, what exit liquidity means is that it means, let's say, let's discuss hedge funds. So what hedge funds do is let's say they invest in a certain stock or asset class before everyone else because they're sophisticated and they do the research. And then the exit liquidity for them is the retail investor that catches on too late. So what that means is then us three, we hear about something about Bitcoin or about a real estate trust or wherever it is, you know what I mean? And we start buying. When everyone catches on, the smart investor is out. So when everyone is catching on, we are all of us that are catching on at the tail end. We are the exit liquidity for the sophisticated investor. So what that means is that now, if everyone is talking about a suburb, and you can actually see that, you can see a lag in Perth, for example, for about a year. Now, sophisticated investors were in Perth 4 years ago. Then the longer you go towards, or the closer you come towards the current time frame, the sophistication fades of that investor, which means that we mainly start relying on the actual narratives, social media campaigns, etc., without actually putting any pen to paper, essentially, to figure out what we want to invest into. Now, does that shape price growth? Absolutely, which is why you have the whips at the tail end. So what usually happens is that you do have this is a bit of a dark subject, but let's say people who suffer from terminal illness, what usually happens is that they feel extremely better a couple of days before they pass away. You know, now this is that kind of a phenomenon. You know what I mean? So it's the same thing for property price growth. You see very sudden bursts at the end, and you're thinking, oh shit, it's going through another top, or it's going through another boom, when that's just the exit liquidity of everyone starting to pile in because they're hearing online narratives. The smart investor was out a long time ago, not only out or sitting on the sidelines. I'm not suggesting that you need to sell off property. So bottom line is, yes, you can shape demand, but I don't think it's infinite and it's long lasting.
What are some of those? That's super interesting. What are some of those things that we need to consider when we're reaching the top? Like, what are some of the telltale signs that, hey, you start to get a little bit worried here? Like, what are those?
So I did actually a presentation on this in our mastermind. I think it's a very relevant topic. I think I did, when you should know you should exit a hotspot. And there are a couple of signs. Let's talk about the first one. The first one is lower levels of socioeconomics respective to the price point. Now, let me explain what I mean by that. Let's say if you have an ERSAD score in the area that is 1 or 2 out of 10, which is disadvantageous. Now, by the way, ERSAD, for people who are listening, it is an ABS metric, which is a relative index of socioeconomic advantage and disadvantage. It has been developed by ABS using 20 different or 30 different sub-parameters. It is actually a very, very interesting, complex, and relevant metric to consider, So essentially just wrapped under one banner, socioeconomic index of advantage and disadvantage. So score of 1 or 2 are disadvantageous areas, socioeconomically disadvantageous. Anything above, let's say from 3 to 8 is neutral, and then 8 above is advantageous. Bottom line, if you see an area that is hovering around the 700K typical price, and yet it has an ERSAD score of 1 or 2, you should essentially consider exiting. Now, why? There is
not mincing words there though. You're just saying, no, that's it, done.
But I'll tell you why no. Now that area might go to 850, but will the 700 turn into 1.4 million? No. And I'll tell you why. There is 0% chance, and I say zero. I was saying about a year ago 0.34% because I was doing the research, but this research has actually adjusted now. So there's 0% chance that an area that's 700K in typical value will reach 1.4 million with an ERSAD of 1 and 2. Go on any platform, go on any database, look at an area, allow for high confidence data set to make sure that what you're looking at is correct. Look at the last decade of growth and set it at greater than 100%, and then see what the areas that are listed, what ERSAD they have. The lowest one is 3. Most of them have ERSADs of 8, 9, and 10.
Affordability, that's the next kind of pillar, the next pillar to all of this. So how should we think about affordability?
Yeah, so affordability, the way we think about it at HTAG is essentially the way we calculate the index is typical price, current cash rate plus 2%, RBA cash rate plus 2% buffer, 80-20 LVR, and 50% of your medium income's going towards mortgage repayments, not 30-50, okay? So it's like a mortgage stress indicator, okay? Now, what we've realized is that affordability index or its preference changes. I mean, you can set it at a hard line of 30 years to own because the mortgage term is 30 years, but it's different in Double Bay than in, some areas that are 550K and below. Now, this is
in my
it does change. So the affordability index for price points that are below 550, and by the way, one of the areas on Kaparinga and let's say Townsville, for example, what classifies those on what happened in Perth as well is these areas had a very, very low affordability index for their price point. So they had an index of close to 20 years to own, which now is extremely rare. There's only Darwin that has that. There's no other area with an affordability index of 20 years to own. So what I'm trying to say is that usually for price points that are 550K and below, you see an index between 25 and 35, okay? For price points that are, or you should be looking at that range at least, to have some kind of short-term and long-term thing. For areas that are between 550 and 850, you should be looking between under 40, sorry. So, I mean, if you can get 31, it's great, but the problem is the more you're restrictive on the index, the more you're sort of narrowing your shortlist. So you have to make certain compromises, and there are ranges for the compromises as well. Bottom line is what I'm trying to say is that if I see an area, let's say Dallas, in Victoria, okay, which some people are talking in context of good investment location. It wouldn't be for me. Why? Because Dallas has an affordability index of 50 years to own for a price point that's 550.
Yeah,
you know,
that doesn't get me all that excited. So it's just not. Yeah, the incomes there just aren't there to support to see that price growth increase.
Exactly. And now, guy, and this is what I always say to everyone. Like when I do strategy sessions and coaching sessions, I go, you got to start thinking. You have to rewire your brain, and you have to think about the notion of probability. You can't. A lot of people say, yeah, but if it's very unaffordable for its residents, it doesn't mean it's not going to grow. Absolutely, it doesn't mean. But there's a higher probability that it won't in comparison to another area that's more affordable and has all the other boxes ticked as well. So this is when you start speaking about probability, you're sort of forcing your user or whoever you're trying to educate, you're forcing them to actually compare and consider it in the context of other purchases under the same brief. So when it's
start
very
bringing up some of this, sorry, sort of you're in a good state.
I need to let me just give the nugget. So that's number 2. Number 3 is weakening short-term demand. Okay, you usually see that as a rising trend in days of market. And number 4, now you can have all 4, by the way, or you should have at least 2 or 3. Number 4 is increasing vacancy rates, both short-term and long-term trends. That indicates oversaturation with investors. So that's very important to consider, guys. Anyway, going back to
can you give us the 1, 2, 3, and 4? Because you said there was a lot.
Low socioeconomics respective to the price point. Yeah, okay. So
this is when you're peaking a boom, right? This is when we start to say, look, this boom's starting to get unaffordable and difficult. Okay, sorry, mate.
Yeah. So you pick affordability index that's above 3, usually. In most instances, they should be above 3, but even above 5 in some instances, out of 10, of course. Then you're picking areas that are extremely affordable. Again, everything is relative to the price point. The index, the socioeconomic index, as well as the affordability index. Make sure you're picking areas that have severe supply scarcity established, both long-term and short-term, and make sure you have areas that have, improving vacancy rates dropping both long-term and short-term, which means that rents will be increasing. And if the area hasn't boomed already, rents will come to a point where it becomes more sensible to own than to rent. And then you see that essentially demand for rentals shifting to the demand for ownership. You know what I mean? So you see a reduction in the days on market. Anyway, that's essentially, I don't know whether, I can do a bit of a narrative about this and send it to you guys, but those are the things that I start looking at from the onset. And you'll see that in all of these areas, by the way. Now, this is the growth rate cycle. And you see the pump from 2019. So it was at the bottom. Now, these are all of the LGAs within Onkaparinga region. Okay, so just imagine that it sort of morphs into one. So we see growth rate cycle highlights the rate of growth that the area has experienced, So you see the rate of growth increasing phenomenally, essentially from 2019 or 2020, as I said, onwards, and it started sort of tapering off now. Now, what is interesting about this, region here or this area on the graph is that it does coincide with COVID. Okay, it does coincide with free money, or not free money, but easy access to money, access to funds, money,
massive amounts of savings.
Yeah, massive amounts of savings. All of these things coinciding, which produces this exorbitant growth. Now, we don't macroeconomically live in such conditions anymore, or at this point at least, which means that generating, what was the point? 29% was the top point of growth for one of these areas. In 2021. So you might not get 30, but you'll get 12, 13, 15 in certain areas. Bottom line is, what I'm trying to say is that we've been spoiled by these enormous returns we have seen through COVID. And this is normal.
Yeah, it's not normal, but still, I mean, like if we look at Melbourne, for instance, 2007, a 12-month period, they had 23% growth. Now, post GFC, they also had a bump up in 29 for 19.6%. 2016 over, and this is actually talking to this period right now that you're talking about, where they had 13% growth from 2013 to 2017. So that's a lot longer of a time frame to have 13% growth rather than 20, 23% in 12 months.
I think we do, yeah.
Yeah, but also the goal of a property investor then is, my goal is to get the best property in the best market at the best price for my brief. So I'm trying to go out there and get the absolute best asset, and be it 15% or be it 25% or 50%, whatever it is, if it's the best market, you're going to ride whatever growth that it has, because you can't really predict. I mean, you guys are trying to predict it here, but there's no real way.
So you can predict it to some extent. Like you can say that, yes, there is data and metrics to look at it. So that is a prediction.
You can predict to higher levels of probability. I agree with that. Otherwise, we wouldn't have a business. So you can do that. But I know what Joey's saying. Okay.
Yeah.
Now, what is what I wanted to say? Sorry, it just escaped my mind. So you as anyone that's an investor, okay. And this is one term that we should internalize and understand. And a lot of us know it. Some of us don't know it. It's opportunity cost. What is the cost of me investing in an area that's not going to deliver as much as some other areas that I could be invested into for the same brief? Okay. So you are trying to outpace, your erosion of purchasing power, whether it's through CPI index, debasement of currency, all of these other things. What you're doing with investing, you're building wealth, but you're also trying to outpace any other asset class that you can be investing into. Why would you invest into property if you can have a term deposit that's going to give you 15% return? You put it in a bank, it sits there, you don't need to look at this data nonsense, and it gives you 15%. Now, that is a fib essentially. No term deposit will give you 15%. But what I'm trying to say is that your opportunity cost is you trying to outcompete any other asset class, and also take account of leverage and the fact that you can leverage in property and not in other asset classes. But you're also trying to outcompete any other area that you could be potentially investing into for the same brief, which means that in some instances, you can be outcompeting everyone else with 7% growth, okay? Because that is what the market gives you at a particular stage in its cycle or at a particular macroeconomic condition. If the printer goes berserk again, for example, and you see, by the way, we are phenomenally restricted by the notion of affordability anyway. I think the gap between wage growth and property price growth has been the widest since 1970. So I don't see an instance in which a printer will go berserk and we're going to be making these, double-digit returns in 3 years. I don't think it's going to happen. But if it does happen, then in that instance, you again look for the fastest horse. So if everyone is making 15, you have to make 17 or 18, and you lay information that way. So, you are bound by what the market gives you, is what I'm trying to say. And just because somebody made 30% in Perth in 2021, it doesn't mean that you can do that today.
Yeah, exactly.
So booms, by the way, booms as well are going to look different. A boom in Melbourne is going to look different from a boom in Perth.
Yeah.
I don't think, and this is going to stay, people can quote me later, I don't think that Melbourne will get to a point where you will get 30% returns 3 years in a row, averaged annually. I don't think it will get there.
What do you mean, 10%, 10%, 10%, or 369? Like to be 90% overall? 30% overall or 90% overall?
Yeah, I don't think it's going to be 90% overall.
No.
Like it was in Perth, essentially, yeah, Joe? Because it was around that for 4 years. Yeah. So Melbourne is not going to be like that. But is Melbourne a hotspot or a boom area, or will it be in the next 4 years? Yes. But this is a perfect example that highlights to you that not every boom looks the same, and not every boom retains the same. Now, the reason why Melbourne is a boom is because it will most probably return the most, compounded return in the next 4 years than other areas. But it will not be 90% in my view.